two sides of contract and frictions, right? Adverse selection and moral hazard. Okay, that's the bottom line of pretty much most of the problems in the world. Okay, and you see here, control ownership separation will come into the picture as well. And when that's the case, I'll ask you for your response. All right, but this course is called Finance Theory, and the program is a finance program. So one way or another, we need to talk about the financing things about financing, rather than sort of just economic principles, okay? Although, what people call finance is actually financial economics. Quite a while ago, there used to be no discipline called finance. It is just a vocational topic, informal. It's not quite discipline as such. Okay, and then it, I think the start of finance was that, hello, Chapui. But he's better looking than Chapui. I think initially a course in finance was offered as a summer course. Not at the Department of Economics either, but at a sort of trade school. It's a trade school, right? Not real discipline. But anyway, that was before it was born. I was told that. Okay. So let's bear in mind the stuff that we covered, we discussed before the new year. Okay, because it helps us understand, it will help us understand a lot of what's going on in terms of financing choices, how firms finance their positive NPV projects and not negative NPV projects. Why not negative NPV projects? The financing is for, or the financing choices that we observe, day in, day out, equity, debt, people call financial innovation, security design, whatever. These are all contracts, right? And so all these financing contracts or choices or alternatives, okay, basically are all about funds, okay, being raised to finance positive NPV projects. So we're not going to worry about negative NPV projects. Let's assume those away. Assume. Is that reasonable? To assume away negative NPV projects. Would that be reasonable? I think yes. Why would you want to finance negative NPV project? What for? We were taught to get rid of them, right? To stay away from them and accept only positive NPV projects. Okay. So in some model, at least picking out the theory, as you will see, perhaps after the midterm exam, the assumption is that firms face, all projects facing firms have positive NPV. Okay. But back to financing alternatives. We observe various type of deals, okay, for different firms. Okay, and different financing choices, debt, equity, hybrid, convertible, warrants, okay, selling contingent claims first, okay, or a short maturity, long maturity, callable bonds, non-callable bonds, all sorts of things. Okay, they call different names, right? Because they have different attributes. Okay, or these contracts have different terms and conditions. Okay, so the payoffs, expected payoffs, to both sides of the party varies across contracts. Okay. So even this variety in the real world, out there that we observe, perhaps it is reasonable to, let's say an early conclusion that we could draw is that of these different terms and conditions in a contract would benefit different firms, but firms in different situations, firms facing different constraints in different ways. Okay? What do you think? Don't need to think, just take it. Right? Yeah. You should think so. Okay. When we think about financing, first should be equity. We would probably think of equity. Just imagine you start up a business. Okay. Have your own business. What would be the first type of financing that would go into your business entity? Debt or equity? That would be equity, right? It's basically entrepreneur forking money out of their own pocket and put it in the business's balance sheet. Okay, and there are several different ways, of course, for firms to raise equity money. Okay, and naturally, there are more alternatives, more ways to bring equity. Okay, greater variety of contracts through which to bring equity money into the firm. Think of balance sheet. Okay, the bottom right-hand side of the balance sheet is equity. Okay, so listed firms have more choices. Okay, in terms of how they're going to bring equity money into the firm than, of course, unlisted or private firms. This is also the case for debt financing, as we will see. Right, for unlisted firm, what's the key feature of equity in unlisted firm, if you can think of? It is not readily tradable. Just equity. We all know this. So what? Why do we need to mention this as at the master's degree level? The implication is that unlisted firm equity would have low valuation relative to equity in listed firms. Right? Do we have evidence on that? That is valuation for two otherwise identical firms. One listed, one unlisted. Okay, the valuation, okay, the value that market participants attach to equity, okay, is higher in the case of listed firms than in the case of unlisted firms. Okay. You agree with this? Should ask, yeah, in principle, maybe. Is there any evidence? Is there any evidence? Yes, there's evidence, okay? And you can think of a study on this. But also, when we look at the IPO market, okay, why would owners of private firms, if possible, they would want to take their firms public? Why is that? Because their wealth would basically soar, right? The wealth would jump. For a private firm, try to do a PE ratio for a private firm. The P would come from valuation, right? Whatever valuation technique that you want to do. Okay, you may get a PE of 4, maybe, right? Or 5 for a private firm. Right? The firm does not have to be listed yet. Okay, but you go through the IPO process, estimate the offer price, and use the offer price as the P, divided by earnings, the same earnings. Okay, the PE could jump from 3 or 4 overnight to 8, for example. Okay, we talk more about IPO, these aspects of IPO well, not we, I talk more about this in the corporate finance course. But if you want to know about it now, ask your classmates for their lecture notes. Some of your classmates, they did advanced but 5. You still have the lecture notes? Still have the lecture notes? Yes or no? No. Huh? You what? Advanced but 5. Maybe that's not a good sign. What about one at the back?
Let me go back and buy.
Okay, that's a good sign. Okay. It's okay, stay longer. Stay longer. Okay. Well, why is that? A lot of people say liquidity. The reason is liquidity. Okay, the reason for low valuation. Okay, what does it mean by liquidity here? It is difficult to turn equity in private firms into money than listed firms. Okay, for listed firm, we hold stock in listed firm, right? Hold shares in listed firm. Whenever we want money, we can sell the shares, right? Shares in listed firm are really tradable, at least in principle. If we talk about real stocks, then we can do that straight away. But if we talk about some stocks in the UK, a lot of stocks, small stocks in the UK market, or a lot of stocks in emerging markets, you may have some liquidity problem. Okay, because the market is not deep enough. Okay, so as a result of low valuation, it is therefore difficult for private firms or unlisted entities to raise equity money, to bring in new equity. Is that true? Yeah. That's pretty much true. Ask yourself, would you, for the two firms, two otherwise equivalent firms, one listed, one unlisted, okay, you're offered stocks, okay, in which firm would you be more willing to invest? Listed or unlisted firm? Listed firms, right? Think about cars, closer to us maybe, to a lot of you maybe, okay? Two brands, pretty much the same specification, same everything. Same engine size, same quality, two brands, okay? One brand is Toyota, the other brand is a Nissan. Which one would you go for? Other things constant. Quality is the same. We go for Toyota. Right? Why is that? Second-hand value is better. Why would second-hand value be better? It's easier to sell. There's greater demand. Okay, so Toyotas, basically in this case, have more liquidity. Okay, right. But I want a bit more from master's students, not just a story of liquidity, because this is straightforward. It is what we could observe directly, but there's further implication. Okay, why do I require more? Because master's holders of master's degrees, at least traditionally, are expected to be able to work as policy makers, not just receivers of well-structured instructions. Okay. So let me ask you this question. What's the link between the difficulty, okay, to bring in new equity money? Okay. What does that mean? Difficult to bring in new equity money. To have new shareholders, right? To have more owners. Because if you invest equity in a firm, effectively you become shareholders, right? And shareholders are ultimate owners, right? Okay. So from now on, you need to make all these links by yourself. But for this link, let me ask you, what's the link here? Difficulty to bring in equity money and the economics of control ownership separation, or the benefits of specialization in decision making and risk bearing. What's the link? If it is difficult to bring in money, bring in equity money, okay, would it, how feasible would specialization in risk bearing be? Would specialization in risk bearing be feasible, easily feasible? Or is it difficult to specialize in risk bearing?
Difficult.
Difficult? Why is that?
Because since it's hard for you to get working capital, you'll be more, whatever you have, you'll be more careful while investing. So you don't want to be risk bearing.
Yeah, but what's the link between this and specialization in risk bearing?
I understood that to mean that you want to take risks in markets that are not explored, but in order to do that, you must have the backing, right? And if you don't have equity money or working capital, how are you going to go about doing it?
Yeah, but let's say let's hold constant working capital. How could landlady specialize in risk bearing in our farming example? Specialize in bearing the risk of actions, of residual risk, okay, in the farming business, that is, the wealth effects of farmers' decisions. You need to be able to exchange claims, right? If landladies can exchange claims among themselves, then they can diversify. Right? If you cannot diversify, you won't be able to specialize in risk bearing. Yeah. We're talking about an example of R&D. Okay, specialization in decision making as well. Okay, R&D. You want the best scientists, throw money at them, get them to think and come up with what's best, right? And that costs a lot of money. Yeah. So if the firm has a single shareholder who cannot diversify this shareholder, right? We have to absorb the unsystematic risk as well. Okay, but if shareholders can exchange claims among themselves, many R&D firms, they hold stock across different, hold a portfolio of stocks in, let's say, R&D firms, high-tech pharmaceutical firms, then they can diversify unsystematic risk. Okay. You still remember the term alienability? Okay, go back to lecture notes. As long as claims are perfectly alienable, okay, that is perfectly tradable, can be detached, okay, alienated, okay, detached and trade, okay. So if stock is not really tradable, shares are not really tradable, then we're not going to be able to get other people to come in and help us absorb the risk in the firm. We get other people to absorb the risk in our firm. Then when we exchange claim, we help them absorb the risk in their firms as well. Okay. In this, you can think of this as risk sharing. Okay. I think we'll be talking about this as well. Risk sharing, economics of risk sharing in the case of bond financing versus debt financing. Okay. All right. let's carry on with an alternative for equity financing. Apart from just normal equity, mainstream equity financing, okay, get a partnership in case of private business, get the equity business partner, right, and the firm will become partnership. Okay, that's one way. Another way is still have the single entrepreneur and look for venture capitalists. Okay, so venture capital is another potential source of equity. What is venture capital? When people ask me, what is venture capital or seed capital or whatever, including crowdfunding that they call nowadays, to me this is just venture capital. So what is venture capital? Venture capital, I would say equity that is extremely expensive. What does it mean extremely expensive? Well, if you own a private firm and you want to get money from venture capitalists, you're going to have to give up a deep discount on the shares you sell, okay, or give away to the venture capitalists. For example, your company is worth 100 baht. Okay, the worth of it, say the entire company, assuming debt-free, it's worth 100. Okay, and you want to raise 30 baht, right? So how much ownership would you have to give away? In general, or you could call this a fair value. What is the value of 30%? 30 baht, right? Right. So you want 30 baht, so give away 30%, right? But in this case, you'll be getting 30 baht, but give away 40%. Right. So you have to sell equity at a deep discount if you want to raise money, equity money, from venture capitalists. Why is that? Because when you have to raise money from venture capitalists, it means that no other people would give you the money, would invest in your firm. Your business is a very high-risk business, okay, and requires a lot of insights, let's say tacit knowledge, to get your business idea or your IT, high-tech, whatever idea that you have off the ground, to commercialize the idea. Okay. Just money can't do it. And you can't do it by yourself. You're a good programmer, for example. You come up with some whatever app, whatever software for the phone. Right? You want to be able to commercialize it. Right? You need perhaps a business guru in the area to do it. Okay, to try to commercialize it. Okay. So as you can see here, okay, something has got to give. Venture capitalists have to put in quite a lot of money, okay, in your venture, okay, and they have to be involved in the management of the venture as well. Okay, so there's a lot more than money that is being invested in the firm, so they require return, naturally. Okay, so they require deep discount. Okay. A lot of people want to say, yes, venture capitalist funds, venture capital, industry, this and that. To me, there's only one place in the world where if you invest in a venture as venture capitalist and get reasonable return, and that's the US. The only feasible venture capital industry, the only place where there can be venture capital industry is the US. Okay, about 12, 13 years ago, the Thai government was trying to promote the idea of having venture capital industry, venture capital financing in Thailand. How do I know that? I was approached to do research and to get all these. When I heard the thing, I thought, yeah, based on what I know, it should be perfectly impossible. Okay, so I thought I would include this topic in my teaching in Thailand as well. Okay, because it seems that people misunderstand a lot of stuff about venture capital. It's okay, easy to put your money in, but you can't get out, right? The only profitable exit to me, okay, and to a lot of people, to a lot of my colleagues, not in Thailand perhaps, a lot of my colleagues in the US and in Europe, we all know that the only, let's say, profitable exit for venture capitalists is through IPO. Okay, so the viability, okay, or the level, or the height of venture capitalist industry depends on the temperature of the IPO market. The IPO market is cold, basically venture capital industry, the VC industry is going to be cold as well, right? Because expected exit is going to be very difficult. But of course, if you talk to a lot of, say, consultants, people from the industry, consulting industry, especially in Thailand, they would say that no, this academic is wrong. He is an academic, he stays with book, right? But it's okay. But that's okay, that's fine. The thing is, a lot of people, especially practitioners in emerging markets, okay, believe, and a lot of them know, and try to make believe that the common exit is through acquisitions. Okay, that is, invest in Thaicom. Let's say it was a startup, right? And sell Thaicom to another parent. Of course, in the VC industry, we observe the exit, about, let's say, 90% of exits are through acquisitions by another parent company. Okay, but that's not a profitable exit. That's just like liquidation. Okay, the ideal, the most desirable exits, and what it is IPO, right? Through IPO, and this is what all venture capitalists or VC fund managers really die for. Okay, to exit through IPO. Okay, let's say you raise 100 funds, okay, to put in 100 ventures, okay, for over a period of, let's say, 6-7 years, let's say 10 years. I cannot remember the figure exactly, but out of 100 funds that you raise, okay, for 100 ventures, right, or out of 100 ventures that you put your money in as venture capitalists, if you could take, to say the safe side effects, let's say 5, right, you exit for 5 out of 100, you could exit through IPO successfully, right, you become superstar in the US market. That's the magic number. You don't need to be able to take 20 ventures public, right? Exit through IPOs, not 20. Okay, but if you can do 5, you'll be superstar. If you can do 3, you become really well known. Right? Why is that? Because the valuation at the IPO, the offer price is high. Right? The valuation is a private firm, and the valuation using offer price, right, as the denominator. Let's say PE ratio, valuation multiple, more than triple. Okay. Right. So that's the story in brief with the venture capital industry. So, as a financing source, it is, or from the entrepreneurs, firms, owners' perspective, it is very expensive. Okay. Now, moving to listed firms. Several ways to bring in equity. One is SEO. Okay, seasoned equity offering, as opposed to unseasoned. Season here is not seasoning, as in salt and pepper. Season is being through season. It is a season. Okay, like a seasoned author, a seasoned editor, a seasoned referee. Okay, so IPO are also called unseasoned equity offering and unseasoned equity issue. If you read old papers, you come across the term unseasoned. Okay. Right. In Thailand, they just call POs, public offerings. Okay. If what I've heard is correct, but I don't really care. I think they call POs. People call PO, and private placement, people call PP. And when you go to an island, you also go to PP. And they call RO, rights offerings. Okay, so when you write it down or you speak, when you call rights offering, don't go light offering. Okay, not right offering. Right offering means a correct offering. You're going to say RO, always with an S. Rights offering. Okay, same as this is a developed country. People will start calling you the bank or the that. Always with an S, please. Right? Otherwise you look funny. Okay? And when you talk about earnings, the company's earnings, always earnings, not earning. Okay? So if you sell rights to raise equity money, okay, basically you're selling warrants to existing shareholders. Okay? And these are warrants are call options on new shares. Okay, warrants are call options. Of course, you can also sell warrants to members of the general public as well. Sell calls on new shares to members of the public in general. In this case, they're not called rights. Okay. But if you sell rights, you sell warrants to existing shareholders, they call rights offering. And when you sell rights, you don't get any money. You give rights to existing shareholders. But it's selling, it's the same, right? But you don't take the money. You want to sell more shares, new shares to existing shareholders. Okay, and this is why they call rights. Here, financing decision, financing choice, in this case, in the case of rights offering, is driven by an ancient legal doctrine. Okay, the old English common law, right? Which basically view a company as a club. It's a club. A company, to start off with, was a club initially, and a club has members, and this club does trades. Okay, so if there are more activities which require more money, and those activities are profitable activities, so who should be able to share the expected profit of these new activities or the new trades? Existing members of the club. Okay, so existing members of the club or incumbent members of the club should have the rights to participate in new profits. So that's over time is being made into law, or commercial law, or company law. If you look at the Companies Act, UK, right, you won't find the term shareholders. You find the members of the company. A company and its members. Okay. So this is the idea behind rights offering. Existing members of the club should have the rights, preemptive rights, okay, to the expected profit. Not the new members, not other people, existing members. Okay. Okay. So listed firms can sell warrants as well. Okay. But of course, these choices, even among listed firms, vary. What does that mean? Not all firms, for example, can do POs or can make SEO. Small firms can't do SEOs, basically. Okay, that's a general rule of thumb. Why is that? It's not, well, basically, it's not economically justified. It's not worth it. By nature, an SEO is underwritten. Right? It's a firm commitment. It's underwritten, so the cost, issuance costs, are very high, and a big chunk of issuance costs is fixed. Right? So if the issue size is not that big enough, the issuance cost will eat up most of the proceeds with very little money left to the firm. Okay? Which makes perfect common sense. Now, given the nature of warrants are call options. Okay, sell calls first, right? Get a bit of money first, and then once the calls are exercised, then get more money, because shares are sold when calls are exercised. And the literature, especially textbook literature. Okay, so guess that. You understand when I say textbook literature? Textbooks. Right, there could be two types of literature, okay? Textbook literature and papers, original papers. So when you read textbooks, bear in mind that you're reading someone else's interpretation of the original literature. So I don't like some textbooks, because I think the authors are idiots. Some of the famous textbooks, I've met the authors, and he's not very deep. He's good at writing and blah blah. But anyway, a lot of people enjoy reading blah blah blah. But he's very famous. I met him once, and I thought, yeah, no reason to spend time talking to him. When you go to conference, you meet some of the guys that you know it's not worth talking to. Let's talk to PhD students, more fun, right, at a conference, or the new PhD graduates. It's a lot more fun talking to them rather than some of these guys who are authors. But yeah. When I was a student, I thought, well, if you're authors of a textbook, got to be something close to God. Until I heard someone said, first round number one. Yeah, this is what this guy said, the big guy. Said, well, the fact that an author has got all the equations correct in his textbook doesn't mean that he's right. Actually, he's a bit of an idiot. It's useless, not great. When I heard that, I thought, Jesus Christ. Wow. And then, as I grew older, not old, older. Yeah. Talked to more people, got to meet more people, and I thought, yeah, that is clear. That is true, actually. Anyway, textbook literature says that, well, firms about warrants, firms that prefer to sell warrants, or firms that are observed to sell warrants, okay, instead of selling common stock or common equity, okay, they would do that when the market appears to overestimate their risk. That is, when firms' risk tends to be quite high and firms happen to need equity money, they won't sell straight common stock. They will sell warrants. Of course, I don't need to say warrants first, right? And then equity, no need to say that. You sell warrants, then when warrants get exercised, right, automatically this is a two-stage fundraising. Sell calls first and then sells underlying assets. Okay, so when firm risk is overestimated, firm sells warrants instead of selling stock. But when risk is not overestimated, yeah, we tend to observe selling stock, okay, sale of straight equity. Textbook suggests that, textbook literature. If people say this to you, or if people or your boss, okay, who's an engineer and got MBA, engineer background with MBA instead of engineer with background in finance, asks you, hey, why is that? My MBA lecture notes says this, and yeah, we need money, and we need to bring. Our firm need money. We need to raise equity money. And people say, look, when risk is overestimated, risk is very high. In other words, sell warrants. Okay, but when risk is not that high, sell straight stock. Why? I want to make an informed decision here. So I need to understand the rationale behind this thing that a lot of people say. And my MBA lecture notes sort of say this as well. Any idea? Not sure. Let's go back to the basic. Let's start from what you know. Don't start from what you don't know. Okay? This is a problem with in exam as well. Students want to start from what they don't know. They hardly start from what they know. Let's start from what we know, or what you know. How is call valued? You've done derivatives, haven't you? No? Let's say you have. Okay. How's an option value? Black-Scholes. Yeah? Black-Scholes. How many parameters are there in an option valuation model? Doesn't have to be Black-Scholes. What are the 5 factors that drive the value of a call option, let's say? Same as put option through put-call parity. What drives the value of a call option? What are the 5 factors? Anyone with sort of economics/finance/accounting background? No one with finance background. No problem. I shouldn't have come to this program at all. Yeah, did bachelor degree here. Now doing master's degree here as well. It's a big mistake. 1, exercise price. Right? Have you heard of this? Exercise price. 2, spot price. Yeah? Actual share price. 3, time to maturity. 4, discount rate. Okay, because that's maturity. If we have to value the option before expiration, before maturity, right? That's time. We need to do some discounting. What sort of discount rate do we use? I'm looking at. Sorry? What does that mean? Government bond yield. Greek government? Sorry? Okay. Which market are we talking about? Greece? Then you use the Greek government bond yield? The Greek government is on the verge of going bankrupt. Why? What do you mean? Why you want to use government bond? What's the idea behind that? What's the reasoning? It's risk-free. Yeah. Okay, so let's say risk-free rather than government bond. Is a government risk-free? So we use government bond as a proxy for risk-free rate. Don't take government bond as risk-free asset. Okay? Because a risk-free asset must be an asset, by definition is an asset that offers return that is constant across states of nature. Upturn, downturn, still the same return, right? That's why it's called risk-free asset. Okay. But government bond actually is not quite like that. But okay, closest, right? Not corporate bond anyway. Something close, as a proxy. Why not risk-adjusted discount rate? Why risk-free rate? Why? Could be an example. But it won't be so straightforward the way I said questions. There'll be a few questions that you come in and you could close your eyes and tick and you get the right answer. Few only. Okay. Why risk-free rate of return? Can investors hedge in the Black-Scholes world? Can investors perfectly hedge their positions? Yes. Right? Is the market perfect? Is the capital market assumed to be perfect or imperfect in the Black-Scholes world, for example? Perfect, right? So in a perfect market, investors can construct portfolio to hedge their positions, right? Perfectly. So if investors can hedge their positions, why should they be entitled to any rate of return that is higher than risk-free return? No. That's why risk-free return is used in option valuation. Okay? Because in option valuation models, investors are assumed to be risk neutral. They are risk neutral because they can hedge. And they can hedge because market is perfect market, assumed to be perfect. Okay? When you have to do derivatives? Okay, so this is background for derivatives. Good background. Okay, this is the fourth factor. What is the fifth one? Volatility, sigma. Right. Sigma. Okay, so let's hold constant exercise price, spot price, maturity, risk-free rate. We don't need to hold constant, it's constant anyway. Right? What would be the effect of sigma, okay, or the volatility, or the sigma of the underlying asset on the value of the call option? Let's say when you buy call, generally you know a call option, right? From pre-term. I think you would have heard it. Okay. So from pre-term, when you buy a call option, now that you hold call option, you bought it, when would you exercise call option? Let's go back to, did we do this? No. Have we? No. Okay. When would you, let's say, if you buy a call option and the exercise price is 10 baht per share. When would you exercise? When the price, the spot price is above or below 10 baht? Above 10 baht, right? So the higher, right, the higher the spot price, the greater the value of the call option, held by you, of course. The more value the call option would generate for you, right? Because when you exercise, you pay the exercise price, but the value is 15, you get 5. How? Well, basically you can buy at 10, right? Get an asset worth 15 and resell. Okay? So you want to maximize the probability of the spot price being very high. You want that, right? But if the spot price dips below 10 baht, the exercise price, what would be your loss? Let's say at any particular point in time, let's say upon maturity, you have to exercise now. If the spot price, exercise price is 10, right? If the spot price turns out to be 6, what's your loss? Not 4? That's right, the cost of the call. So you lose only the call, right? What you lose is the value of the call, right? You don't need to buy at 10 and sell at 6, right? It's your option, the right to buy. It's the right to buy, okay? It's an option, that's why it's called option. Okay, but on the other hand, if the call is in the money and the spot price is 20, spot price has shot up to 20, okay, at expiration upon maturity of the option. What is your loss in this case? What's your loss? Not a loss. What is your gain? Yeah. Well, basically, yeah. The value of the call that you have paid, right? The call premium. Okay. So 20 minus 10. So you exercise only when the call is in the money. Right? So your downside loss is capped, not capped. It's limited to the value of the call. The amount of money that you paid to buy the call, right? Yeah? So downside is limited. In this case then, do you want the value of the stock to be volatile or stable? Downside is limited. Need to be volatile, right? And stock is the underlying asset in this case. Okay? So you want the stock to be volatile. So what's the effect of sigma, of volatility on the value of the call? Positive or negative? Positive, right? Okay, so the value of the call is a positive function of sigma, okay, or the standard deviation or the variance or volatility of the underlying asset. Okay? So, if firms, let's say managers, assuming that they are better informed than outsiders, okay, and they see that their firm's risk is overestimated. The risk is too high, right? The price of the firm, okay, let's say as the price of the firm's asset, we could assume that pure equity firm for simplicity, but we could also allow that. But that is fixed claim. Okay, so for simplicity, but without loss of generality, we could assume, okay, in our example here, that the firm is a pure equity firm. Okay, so the price of the firm's equity, the firm's share price, right, is the price of the left-hand side of the balance sheet, for pure equity firm. Okay, price of the assets. Okay, so let's say we are managers and we observe, we see that the price is quite volatile, and it is too volatile given the nature of the firm's assets and the expected underlying cash flows. Okay, so we think, well, risk is too high, right? Given what we know about the firm's assets, about the firm's future projects. Okay, price is too volatile. Should we sell equity or should we sell warrants in this case? Sell warrants, right? Other things constant, the sigma of the underlying asset, which is the firm's stock, is very high. Okay, so warrants, being call options, will fetch good value. will fetch a good price. But if we sold straight stock, right? Straight common equity instead of selling calls first. Okay? What would be the valuation? Go to the basic valuation formula. Go back to what we know. If you feel blank, go back to what we know. Or we don't know anything. I hope we know something. How would you do valuation? Equity valuation. Nice and simple. Where does price come from? Come from past or come from future? Price. Where does stock price come from? Future or past? Both? Really? When you do valuation, do you include past cash flows? From preterm. Did preterm teach you to use past cash flows? No. So price is a function of future expectation, right? Yeah, future cash flows. When we do valuation, always discount. Do we discount past cash flow back to present? Is that what discounting is all about? No. We discount future cash flows, right? Discount back to present. Always. To get the NPV. Yeah? And NPV becomes price. It's basically price. Okay? So, if we sell straight common stock, right, think about the normal discount formula. Expected cash flows, yeah? And if we think that the cash flow stream is very volatile, the cash flow stream should be relatively high risk or low risk? High risk, yeah? Okay, so the numerator is the same. That's expected cash flow. Expected means the mean, the average. Expected random cash flow. NPV. Yeah? What's wrong with this formula? The T, yeah, good. Do this all the time. I don't want you to memorize it. Okay, when risk is the risk of the string of the numerator is high, what should happen to the denominator? The variable, this is constant, this is a variable. Should it be bigger or smaller?
Bigger.
This is risk. The volatility is high. It's uncertain. Yeah? Volatility means risk, right? Would that be about right? When stock market does this, does it mean stock market is safe or is volatile? Volatile means safe or risky? Risky. Okay. Man, this is very difficult. So what should happen to the denominator here? It should be larger. What should happen to the left-hand side? To the quotient? It should be small. So when risk is overestimated, we sell stock. We get little value. The stock won't fetch a good price. Okay. So in this case, we could sell warrants. Okay, if we sell warrants, we get more money because the call will be worth more. Okay. Okay, second question. So given this, question 1.5, not second question. Risk is overestimated, or the market overestimates the firm risk. Does this mean that the market, does this argument, okay, this suggestion from textbook literature imply, or can it be taken to imply that the market is inefficient? Investors are irrational. That's why they overestimate firms' risk. The market is wrong. Should it be taken to imply market inefficiency? Well, to me, some other people would say yes. I mean, academics. But to me, I would say no. Right? And I think they're wrong. Of course, if there are papers who make this kind of argument, I would reject such papers straight away. Okay? And tell the editor that, look, this is flat rejection. Well, why am I saying this? If there exists information asymmetry, yeah, outsiders know less than insiders, mispricing is possible. Okay, right? Because the market would estimate the firm's value, okay, or estimate the firm risk based on the information that it has. Okay, if the information that the market or outsiders have is not very good, naturally the market should overestimate the firm's risk, right? Okay, I should estimate the firm risk to be high. In terms of value should to be low. Because information is not very good. Adverse selection, the value should be low. Okay. But of course, if the market does not have complete information, let's say, right, and yet we say that the market can estimate risk and value correctly, then there's something wrong with us, with our thinking. Yeah, because price and price-related parameters, right, should reflect what type of information, publicly available information. Should it reflect inside the information? No, it shouldn't. Okay. This is why insiders trading has to be reported pretty much straight away after the actual trading. This is why market regulations require this. Okay. Right. Let's move to question number 2 about selling warrants. Okay, so we observe firms selling warrants. That's just the tip of the iceberg. Yeah, there's a lot more underneath the surface. Okay. Is there any particular type of firms then that would prefer warrants? Or warrants would be more suitable than straight equity? What do you mean, which type of firm? Okay, we can't think. Then no problem. Just let's say high growth, low growth. High growth or mature firms. Which type of firms? Warrants would be more suitable. High growth or mature, i.e. low growth. Low growth? Any other idea? Okay, to get in front and fight. Why low growth?
Because low cost and the price of the stocks tend to be stable or something, and or maybe decrease, and company can gain the profit from the cost.
Okay, so there are two things that I can extract from what you said. 1, stable. 2, decline. Who would buy warrants then? Who would buy calls? If the price of underlying asset is stable, right, and declining, so the call would, if I buy the call, I know that the call would, in time, would be out of the money.
Yes, but you as an investor, you don't know all the information.
Uh-huh.
But the issuer inside the firm, they know something more than the investor.
So investors are stupid. So if you were in my position, you know that you don't know, right? And you know that the price, the pattern is stable, and you expect that it will decline. Would you buy the call? No. So in equilibrium, firms cannot sell warrants. Low growth. Okay. That's the blue corner, red corner.
High growth means high probability for the stock price to grow. So,
Okay.
the investor may prefer to buy warrants.
Okay. But if the price is gonna go up,
We can set up a lot high price and we will get a lot higher.
Sure. yeah. In this case, then you can sell straight common stock because people expect that the price would be high, right? If people expect that the price would go high, then there will be good demand for the stock. So straight common, if you sell straight common stock would fetch a good price. Okay. Right. Let's think about the properties. Let me check how this characteristics of high growth firms. When we talk about growth stock, is growth stock risky or safe relative to mature stock? When we talk about growth stock, risky. Okay. Think about valuation multiple. How would you describe? What sort of valuation multiple would characterize growth stocks? High PE or low PE? High PE. Okay. Is a high PE stock risky stock or safe stock? High PE. Let's say PE of 12, about a dozen. What does it mean, PE of 12? To investors. How should investors rationally look at the PE of or interpret the PE of 12? Price?
Sensitivity of price.
Sorry?
The sensitivity between price and equity will be high.
Where does that come from?
When
Price and equity? Isn't that the same thing?
price and earning.
Price and earnings.
When earnings change a bit, the price will change a lot.
What predicts that?
What
Yeah, what's the mechanism? Earnings change and price change a lot. Right? That's what you said. Sensitivity.
Yeah, because the investor expect that earning will grow steeper and steeper. So PE now is already high. But if the earning becomes not meet the investor expected, the price will change a lot.
Okay. Okay. So that means high risk?
Yeah.
Okay. So it's about meeting expectation then. So the same as low PE. If low PE stock miss the earnings forecast expectation, the price will drop too.
Drop less than.
Yeah, but to drop by the same proportion. Proportionately, should have the same effect. If you scale it into percentage, it should be the same. Right? So technically speaking, missing earnings expectation, right? Okay, missing or meeting earning expectation, it's not unique explanation for high PE stock. So that does not explain why high PE stock is more risky than low PE stock. I raise my case. So no, you won't cut a deal in this case. So why would high PE? So what does it mean, high PE? PE of a dozen. How many years does it take for shareholders ignoring the discounting to get their money back? A dozen years, man. What about PE of 4? Right? Yeah, only a third of the distance. Okay. So there's a lot of expectation Okay, 15 years. Sorry, 12 years. There's a lot of expectation in this case for the P of 12, then P of 4, right? That the stocks will grow, earnings will grow. That's why it gives 15. Okay, and that's why it's called high growth. Yeah. So in this case, then, let me ask you related or follow on question. Where does the value of high PE stock come from? P of 12 and P of 4. Where does the value of high PE, high growth stock come from? Price is 12 times the earnings. So price come from where? Just expectation, right? Does it come from actual assets in place now? No, it comes from the future, right? Future expectation. So expected growth. Now compare that with the stock with PE of 4. Okay, so the expectation is less. So the value come from or derives from a bigger chunk of value, right? Bigger chunk of the price come from assets in place. So when you see PE of 12, how could earnings grow that high? There's got to be some sort of new projects, right? Future projects, okay? And that's growth opportunities, or what we call growth options, okay? So growth stocks, we're trying to get at the second question here. So growth stocks are risky, right? Because growth stocks are risky stock. High PE is risky. Yes, high PE stock has greater asymmetry. It's characterized by more asymmetry than low PE, right? High PE. Yeah, 15. How could we verify the difference? P of 15, difference between price and earnings. How could we verify that? It's difficult, right? Okay. So it's got to come from growth, expected growth opportunities. And growth opportunities are essentially growth options, okay, or investment options. Stuff like this is an option, okay. If the value becomes low, right, then we don't exercise the call options, okay. So when we say growth options, then they are growth opportunities, okay. So growth stocks are the stocks that derive most of their value from growth options or growth opportunities rather than assets in place. Not assets in place. What does it mean, assets in place? Stuff on the left-hand side of the balance sheet. Okay, bricks and mortar, existing factories that produce current cash flows. Okay? You see the difference? Not quite. Okay. Now, think about growth options. And these growth options, okay, are valuable, are treated as valuable, as being in the money. That's why we incorporate it into the price. It gets impounded into price, becomes price in other words. Okay. Basically, they assume, growth options assume that they will be exercised. Future projects assume that, yeah, when the right time comes, they will be accepted, they will be taken. This idea, these projects will be executed to become assets in place, real assets. There will be actual investments. So these are growth options, okay, conditional on exercise or assuming exercise. But of course, when that time comes, information may have changed from positive information into negative information. And in this case, then the options will not be exercised because the options will become out of the money. Okay? So, think about how price changes. When will price change? When there's new information coming in, right? Price will change when there is a surprise. right? If the positive information is already expected, it will be impounded into price. Price changes only in response to only a surprise, new information. If information is not new, price will not change. All right, this is the basic principle from say first year undergrad, right? First year textbook. Price will change only when there's a surprise, in response to surprise. Okay, let's say for positive surprise, we think about cross options. Positive surprise, options are in the money, right? Let's try to model this, have a simple model. Surprise is negative, the options will be out of the money, yeah? Okay, so let's say at time 0, options is in the money, let's say, to start off with. At time 1, negative information arrives at the market and the options become out of the money. Okay, will not be exercised. So basically, when this is the case, the whole project is gone. Okay? Now, let's take the opposite side. At time 0, let's say the option is out of the money. But it's in the pipeline. It's still on the desk. But we know that this is a bad project. At time 1, okay, at time 1, positive information comes in, hits the market, right? This out of the money option becomes in the money. What happens to the project? The project is now accepted, right? Before, rejected, now accepted. Think about the size, the impact on the firm's value. The whole project in and the whole project out. Think about it, is the size of the impact on firm value. Bear this in mind. Now, for assets in place. Assets in place at time 0, information is positive. At time 1 is negative. Well, the option has already been exercised. These are assets in place. These are exercised options. Okay? So, when negative information hits at time 1, cash flow stream will get revised downwards. But the project is there, still there, right? Okay, go to the opposite side. Right? On the other hand, at time 0, information is negative, cash flow is low. At time 1, it is positive, cash flow stream is revised upwards. What will be the impact on firm value? It's the same, the size of the impact, the same or different from the case of options in the money and out of the money? Will be much smaller, right? Because in the case of options being in the money, becoming in the money, and becoming out of the money is the entire project in and entire project out, not just cash flow revised upward or downwards. Okay? This is why high growth stocks or high PE stocks is more volatile. Because price change, when positive information comes in, right, or negative information hits the market, it's an entire project. For positive information, entire project accepted. When options are in the money, entire project accepted, options are out of the money, entire project rejected. But for assets in place, only cash flow revised upwards and downwards. Okay, this is why growth stocks are more volatile than mature stocks. Okay, so it's more risky. Another source of risk, if you like, that is associated with growth stocks is the fact that growth options, okay, growth options are much harder to value. And for the value of the growth option to be impounded into price, to be treated as value to shareholders, it must be the case that the options is in the money and will be exercised. So being in the money, 1, 2, exercise are assumed. And these are assumptions. Okay? So it is very hard for people to value growth options. Yeah, there are options. The growth opportunities much more difficult to value than the existing or the assets in place that are already generating cash flow streams. Okay, we hardly have any information about growth stocks or new projects. Okay, and they assume exercise as well, and this is why Mr. KTC, have you done the homework? Which branch is closing? Is the circle closing? Have you checked it out for me?
Not yet.
Oh, the marking on the assignment is going to be very bad. Okay. This is why lenders don't like to take market value as collateral. Would that be about that? Lenders like to take bricks and mortar or book value. Book. Write this off, get it, this is the book. That lenders would take as collateral. They don't take market value. Because market value derives from growth options. Assume exercise. That's why market value of assets don't give good collateral to lenders. And this is why when lenders or people look at leverage, they don't just look at market value. Right? Leverage based on market value, based on book value. Okay? One slide, half an hour. Not in the lecture notes. Not in the lecture notes. I know. I intended it that way. I want to make it that way. Okay. For good reason, of course. I want you to pay attention. Perfectly examinable. Anything that we discuss in class, of course. Okay. Yeah, let's take a quick break before we get into debt financing.